All right, let's talk about the absolutely wild story of GameStop. We're going to unpack how a video game store of all things became the center of a massive financial earthquake, and more importantly, what his crazy journey tells us about the hidden rules that are secretly running the whole show in the financial markets.
So, let's start with this idea right here, because honestly, it's the key to everything. Just forget the spreadsheets and the deep financial analysis for a second. This quote gets right to the heart of what happened. In the heat of the moment, a stock's price is simply what the next person is willing to pay for it. That's it.
And boy, were they willing to pay. At its absolute peak, GameStop stock shot up over 2,500%. I mean, think about that number. It's an explosion of value that turned regular people, folks with small trading accounts, into millionaires basically overnight. And it left some of the biggest, smartest players on Wall Street completely stunned.
So, how on earth did we get here? This story isn't just about the numbers, not at all. It's about a very specific moment in time. The whole stage was set back in early 2021, and it was just this perfect storm of social trends and financial forces all crashing into each other at once.
Okay, so it all kicks off during the COVID-19 pandemic. You've got millions of people stuck at home, they're bored, and maybe they have a little stimulus money burning a hole in their pocket. A lot of them find their way to this kind of chaotic, meme-filled corner of the internet called Wall Street Bets on Reddit. And it fast becomes the command center for this new army of traders, all fired up by this really powerful story. This was us, the little guys, versus the Wall Street pros. People were making YOLO bets, you only live once, hoping to ride a rocket ship to the moon.
And their target, their chosen battlefield? A company that most of the so-called experts had already completely written off. GameStop, a brick-and-mortar store that felt like a relic, a dinosaur from a time before digital downloads took over everything. It seemed like it was just destined to fade away.
And because everyone thought it was a failing business, some huge Wall Street hedge funds like Melvin Capital were placing these massive bets against it. They were doing something called short selling, which is basically betting billions of dollars that GameStop's stock price was going to keep going down and down and down.
But here's where the whole story flips on its head. Some really sharp-eyed people on Reddit, they noticed something. The hedge funds, they had gotten greedy. Get this, they had shorted more than 140% of GameStop's available shares, a number that shouldn't even be possible. They basically set a trap for GameStop, but in doing so, they'd walked right into a much bigger one themselves.
The Redditors realized, hey, if we all start buying GameStop shares, we can force the price to go up. And if that happens, the short sellers start losing billions. They'd be forced to buy shares themselves just to stop the bleeding. And that forced buying, well, that just pushes the price even higher, creating this incredible, catastrophic feedback loop for the hedge funds. It's a classic short squeeze, but it was being weaponized by this huge, decentralized online mob.
Just look at the matchup here. It was completely insane. On one side, you have this chaotic forum of amateurs, and on the other, a professional, multi-billion-dollar hedge fund. And the results were just staggering. You had some Redditors turning $50,000 into over $20 million. Meanwhile, Melvin Capital lost more than half its value in a single month and needed a multi-billion-dollar bailout just to stay afloat.
I mean, the speed of it all was just breathtaking. The stock starts the month at around $20 a share. By the last week, it's closing near $350, and at one point, it even touched $483. We're talking about gains of over 100% in a single day. It was pure financial chaos.
So you're watching all of this from the sidelines, the hype, the story, the mind-boggling gains, and you have to ask yourself, right? Seeing that chart go vertical, feeling all that energy and momentum, would you have jumped in? It's a powerful thought.
Now, it's really tempting to just look at the GameStop saga and write it off as a complete and total fluke, a random, once-in-a-lifetime, one-in-a-billion event. But what if it wasn't? What if all that chaos was actually the perfect, real-world example of predictable patterns that are always hiding just under the surface of the market?
Just think about it for a second. That crazy, extreme 2,500% gain? That's what we call a fat tail event, something that standard models say is basically impossible. The way the social media hype from one day just fueled the buying frenzy the next day, that shows time dependency. And the fact that other so-called meme stocks like AMC suddenly surged at the same time, that's cross-asset correlation. These are the invisible forces we're about to decode.
So let's break down 3 of these core patterns. They're sometimes called stylized facts in finance, and we're going to use the GameStop story to make them crystal clear.
First up, we have something called volatility clustering. It's actually a pretty simple idea, but it's incredibly powerful. It just means that market chaos doesn't happen at random. It comes in bursts. Wild periods tend to follow other wild periods, and calm periods tend to follow calm periods. Storms follow storms.
And GameStop is the perfect example of this. It's textbook. The stock was pretty quiet, almost sleepy for the first part of January, and then that calm was just shattered by weeks of nonstop, massive, wild price swings. One day it's up 134%, the next it's down 44%. The chaos didn't just strike for one day and then go away, it clustered. It created a sustained storm.
Okay, next up is a pattern that's really all about human psychology. It's called asymmetric volatility. And in simple terms, it just means that bad news hits the market way harder and way faster than good news does. Fear is just a more powerful and a much more immediate motivator than greed is.
We saw this play out perfectly. Remember when some brokers, like Robinhood, controversially stopped people from buying more GameStop shares? That was seen as a massive piece of negative news. And what happened? The stock didn't just gently drift down, no, it plunged, violently. It just goes to show you that the downward swing in response to bad news was way more dramatic than any of the upswings from good news.
And that brings us to the final pattern. And honestly, this is the one that really explains the unbelievable scale of what happened with GameStop. It's called non-normality, or more commonly, fat tails. You see, standard financial models, they love this neat, tidy little bell curve where extreme events are way out on the edges and are considered almost impossible. But reality is messy. Reality has fat tails, which means those impossible events happen way more often than the models want to admit.
A standard financial model would have looked at GameStop and said that a 2,500% gain in a few weeks was statistically impossible, a complete fantasy. And yet, it happened. The GameStop squeeze is the fat tail. It is the proof that these low-probability, high-impact events aren't just weird outliers you can ignore. They are a fundamental feature of how markets actually work.
So let's put it all together real quick. Volatility clustering. Chaos comes in bursts. Asymmetric volatility. Bad news hits harder. And fat tails. The so-called impossible happens all the time. 3 big statistical ideas, all perfectly demonstrated by one completely unforgettable story.
Okay, so why should you care about any of this? Why does understanding these patterns matter to you? Because they're not just some academic theories. They're a practical toolkit, a way for you to make sense of all the noise and the hype and the chaos you see in any market.
So what's the big takeaway here? Well, first, markets aren't totally random. They have a structure, they have predictable behaviors if you know what to look for. Second, those wild, extreme events, they aren't a bug in the system, they're a feature. And knowing that helps you see past the hype and really understand what risk looks like. And maybe most important of all, these rules don't just apply to meme stocks, they apply to everything.
In the end, the GameStop saga wasn't a magic trick. It was just an extreme example of the market's true DNA. These patterns are always there, playing out under the surface. And now that you know what to look for, the real question is, could you spot the conditions for the next one?